You know, in a world where so many people are looking for minimal drawdowns and they want to avoid all risk, even though risk is required to get the reward, it's interesting that you have found a collection of clients that still want to make money.
Well, I'll actually take you one farther on that.
They want to make a lot of money.
They do, but I'll go this far. The more that I've thought about it, the more I've come to the belief that the optimal is actually the least risky way to trade it.
Okay, explain.
Well, think about it this way. If I have a program with low drawdowns and low volatility, what's going to tend to accompany that is low returns. And so if I'm going to have low returns, then I'm going to need to invest a lot in that program to either have that much punch in my portfolio or to make the amount of money that I need to or would like to make. Does that make sense?
Absolutely.
And so the way I look at it is that regardless of what the past performance is, regardless of what you think, the amount you have at risk is the amount that you invest. And so, and I would go one step further and I would say real risk is the difference between anticipated worse loss and realized worse loss. If the future performance of every investment stayed within the boundaries of our models, no one would ever really have a problem. Something might lose money, but it would never lose more than we, quote unquote, thought it could lose. However, as we know, that isn't always the case. And so when I'm having to make these large investments in lower or low volatility or low return programs, I leave myself open for huge amounts of unanticipated loss. That makes sense?
Absolutely. Absolutely. You're saying allocate less and put it in a more risky type strategy.
Well, rather than risky, I would say a higher return program. Because here's the thing. Let's say I wanted $10 million worth of punch of Covenant Capital's original program or of trend following. And your standard trend following model, you know, it's kind of trying to make 10 to 15% with a 15 to 20% worse drawdown. If I invest in the optimal, instead of putting up 10 million or opening a $10 million account, I could get that punch for probably 2 million. And depending on how long I let it run or how I reinvested the profits, maybe as little as 1 million. So what's going to happen with those two investments? If I've invested 2 and you've invested 10, you're going to have a hard time convincing me that I have more money at risk. But in the higher return program with the power of compounding, I have a higher ultimate upside.